Hi, I'm Peter Rose, founder of Longwood Currency Trading, and I took a 7% hit against my bank today, screwing around, trying to scrape a little bit off the NFP release. Now, I've made 2-4% on NFPs before, usually through a series of trades. This one was just one big, and I finally cut it, or it would have been a lot more. I was on a good path through the morning of trading. I was up a couple of percent, I guess, and waiting for the NFP number to come out. And the price action seemed to be leading in a particular way. And I had this is the kiss of death. I had sort of a kind of a feeling for what was going to happen. This is a big release date. I'm not going to bore you with all the details of it, because the details of the specific event or time, just because it's September of 2025, make no difference, because each NFP is basically the same thing. You get a lot of volatility in the major pairs and the majors are all USD based right now, because the USD is the big dog in the thing and everybody else is kind of the tail. That's just the way it is. Although the other day, when the UK had their gilts drop out of sight for some reason, the dollar went screaming high. And I just, you have to be careful with the releases when you're looking at the economic news releases, that you're just not looking at your part of the pair country. Like if you're trading, like the pound dollar, if you're trading that, and so your main currency pair, let's say, is the dollar, and so you're looking at what's going on in the dollar release, and that really doesn't do anything. But then the UK thing just goes crazy, and you don't recognize that. You don't see that when you're looking at the release notes and the, on whatever site it is that you're looking at for those economic values for the different countries. And they're listed there. You can see USD, and then before that's going to be UK, or after, or whatever. And if you're not looking, or at least glancing at both of them, the dollar, again, is going to be the big one, but that doesn't mean that the other pair currency isn't going to take center stage. So that's going to be true regardless of the time period that you're watching this video. So I take the aggregate experience that I have over everything, and I don't weight highly the pair that's not the USD component, because I'm in the USD and I'm more familiar with that economy, and that has been leading everything dramatically for quite a while. So we had this thing today where I wasn't really in the market at that particular time, and looked at the chart, and the dollar just dropped out went way up. And I said, why is the dollar going up? There's no reason for that. And then I looked at the news releases that the UK numbers had come in abysmally bad, and I went, oh, that's why that happened. My failure was that just happened a few days ago. So my failure was in discounting that dollar movement as a viable movement from a trend standpoint, just because the dollar had been going down a little, or going up over the last period, and now it had this tremendous spike, didn't necessarily indicate that was a strength of the dollar. And I made that mistake. I discounted the effect of the UK and not the dollar. So now when the non-farm payrolls came, the money that's really playing, a non-farm payroll, a big one like that, are the institutional traders. And they were the ones that were, the price of the dollar was moving down, but it was in difference to the what had been going on the last week or so. The dollar was strengthening, but the prior movement of the price, a couple hours prior to the NFP release, it was going down. I didn't think that was significant. I thought the reaction would be dollar strength overcoming, and so I went in short. And it worked at first. I did okay, as I said, and then just it was like a minute before the NFP release came out, the dollar started going against me, and I thought, well, I'm up a little bit, so I can stay with this. I've got some staying power. I'll just hold with that, and when I get a break even, if it goes that far against me, I'll just tap out. So I'm sitting there watching this thing, and it just went, and I went, well, that's an anomaly. That shouldn't happen. And then it went again, and I went, I'm out. I'm 7%. I'm out. And so when they see that the retail traders are moving in the wrong direction, they just pile in, and then the retail traders got to get out, and they just feed everything, and you get the spike. So after I got out and I'm watching this thing, the price recovered. Well, I was out from wherever it was I was in. I was out 7%, and so the price came back. So if I would have waited, I probably could have got out at this point at probably 4%. Something like that down. But you just, when it goes crazy like that, you just have to take your hit and get get out of Dodge. So the purpose of this video is again to stress, don't study the economics of the market. Don't trade during the economic number release days, which is different than the news, economic news versus economic indicator release. Be aware of it, and then watch it as it goes through, but don't try to trade it. And sometimes you don't check that stuff on a daily basis. I sort of have got in a habit of doing that. I tried to stay out of it before, but because the retail market is so much smaller than it was when I started trading. When I started looking at the Forex market in 2007, it was a $3.4 trillion a day market, and 15% of the volume was the retail traders. Today it's, I think it's $6.7 trillion a day, and the retail traders are only 5% of that. So they're out there scrambling around, and the institutional traders just feed off it. They're moving the market, and they're in the direction that they know that it's probably going to go in, and they have the ability that if they're wrong, they've got the retail traders who are right, and they just feed off of that, and they get out of their positions to a certain extent. That's partially what the pullback from where I stood, a 7% loss, which pips wise isn't that much, but and then it pulls back to 4%. So you get a 3% differential in my position. I was stupid. I got caught. A retail trader. I'm trying to figure out what the economics of a non-farm payroll, slight drop, and the other numbers releases, which were also significant numbers releases for the U.S. today, and I just had an opinion, and that's the kiss of death. I'm just here to tell you, I'm a poster child for what happens when you have a friggin' opinion about what's going on in the market. Don't have an opinion, and when things move against you, get out of there. Particularly if you're in uncertain terms, or the price hasn't really established a really strong, take a 5 pip loss or an 8 pip loss. Just get out. Don't say, oh, well, it'll come back, or I think that this such and such, blah, 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 or it's going to bounce off the 21 period moving average. Oh, well, it didn't do that. Well, it'll bounce off the 55 because that's the, the strength of the market in the long term, and it goes past the 55, and then what are you going to wait? You're going to wait till it hits the 200? Well, you're going to be 100 pips out, 60 pips out. So you have to really, really be careful about inserting your view of the market. I think a lot of the problems with us as retail traders is we think that's what we have to do. And there's nobody out there to tell us different, because the education that's out there, the brokers are not your friends. They're taking the other side of our trades. So they know they got a 90% chance of winning. Why wouldn't you take the other side of the guy's trade if you knew you had a 90% chance of winning? It's just crazy. I mean, it doesn't make any difference whether they take that side of the trade or not. The thing's going to be, if they were pumping the stuff out into the interbank market, if they were an ECN broker and pumping it out in the interbank market, the institutional traders are going to cut your ass off anyway. It doesn't really make any difference. You're dead. Doesn't make any difference who makes the money. But the broker is not offering you valid advice. Oh, let's have a course on economic release data and what you should do around it. Let's have a course on the fundamental analysis of the interest rate policies versus consumer price index, and let's show you how to evaluate it. It's all bullshit. And then on the other side of the coin, they start talking about, oh, let's talk about Bollinger Bands and Fibonacci's and all this other stuff, which have no correlation to what's going to happen during any of these periods of economic indicator release, which is every freaking day. It's just that some of the minor ones, as we go toward the end of the year, particularly, are taking on more significance as a percentage than they might have had 3 months before. So you have to look at the differential of that, how that affects the market, because that's the institutional players trading that, and they've got the information on that. And you can't try to fade the institutional market because it's too big. They're not going to lead the price in one direction and then to get the retail traders all to follow in and then reverse and go, because they've got so much volume behind them. They're not going to be able to cash out with the smaller of the retail market. And because they've all got the same information, they can't try to fade each other. So you've got to really look at price action as to what is price action telling me to do. And your rules have to be based on price action, not freaking voodoo that's being taught out there. Because if you look at that stuff, as long as I've been involved in the markets and knowing that all that stuff is no good, I still have an interest in it. I'm interested in macroeconomics, okay? I enjoy it. So I'd like to know how the economies of the two countries are doing. And that, unfortunately, seeps into my analysis, and I form an opinion. When I've got a student, most of my students don't have those opinions. They're not interested in macroeconomics. They're just interested in making money. Okay, great. Here's a set of rules that will allow you to do that based on what the price action is doing, not what the fuck you think is going to go on because of what you think the NFP is going to happen or what next week's housing starts is going to do. You just can't. You just can't bring that into your thinking. And so most of the folks that I deal with, they don't have my background and they don't have my interest. They're interested in trading. They're not interested in the market. And there's a difference in that. And you can get really jacked if you start looking at the market and trying to tell that out. The problem is a lot of stock traders come to the currency market, and in the stock world, you have to do fundamental analysis. You can't just trade the squiggly line, because the news could come out that the stock that you're in the CEO just absconded with $400 million of profits because he had been booking gross sales and calling it net. That's a real life thing that happened, actually. And you have to be on top of all that stuff. So you can't come into the currency market and use those skills. You can take the currency market skills, the skills that you learn evaluating price action and all that other sort of stuff, because once you evaluate the price action, you then use your information about macroeconomics and indicators and stuff to confirm or look at the divergence between what the market is doing and what the appearance of what the indicators are driving. So if you get an indicator release that doesn't affect the market that much, then probably the current trend is the valid trend and not the one that you would think would happen because of an NFP release or whatever. It's complicated stuff, and it doesn't need to be complicated, and I don't complicate it in my fast track course. And so the students that pay attention to what I'm saying don't form opinions about the market. Their only opinion is based on what they're going to do when they hit bid ask. Are they long or short? And that decision is based on what the price action is doing, not anything else. So if you are watching this and you happen to be a student of mine and you're not as successful as you want to be, you have to look at why that's happening. It's because you've got an opinion and nobody gives a shit about your opinion. So stop it. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day, and forget the opinion, okay? And if you have any questions about this stuff, send me an email so we can have some discussion about the type of training that I offer that's different than what all the rest of the folks are doing. Have a great day.